All right, let's get right into it. We've all seen those headlines, right? That little thrill when you check your portfolio and see the market hitting another all-time high. It feels like you're winning. But what if I told you that for the last 20 years or so, you might have actually been getting poorer? Yeah, let's unpack that.
I mean, turn on the news and it feels like every other month you hear it. The S&P 500 just shattered another record, or the Dow has tripled. And look, it's a great story. It makes us feel secure, like our investments are doing exactly what they're supposed to do. The numbers on the screen are going up, and who doesn't love to see that?
But then you see a quote like this, and it just stops you in your tracks. The number on your screen is growing. Your purchasing power is not. This really gets to the heart of a pretty uncomfortable idea, that there's a huge disconnect between the numbers we're seeing and the actual wealth we have. It kind of forces you to ask some tough questions. I mean, really think about that for a second. We measure all our gains in dollars. But what is a dollar really? Its value is always changing. So if the dollar itself is losing its ability to buy stuff, are our gains really as big as they look? It's kind of like trying to measure how tall you are with a ruler that's made of elastic. The number might change, but have you actually grown?
So, to get a real sense of what's going on, we need a different kind of ruler. And for this explainer, we're going to use gold. Why gold? Well, it's been a standard for preserving wealth for literally thousands of years, mostly because, central banks can't just print more of it. So let's look at the market through these two totally different lenses.
Okay, now look at this. This is pretty wild. We're looking at the exact same stocks over the exact same time period, just measured in two different ways. On the one hand, measured in good old US dollars, you're looking at a massive gain. Awesome. But then, when you measure that same portfolio in ounces of gold, it shows a huge loss of purchasing power. I mean, these are two completely different realities from the very same investment. And that's really the whole point, isn't it? The dollar story, that's the one your broker loves to tell you. It's all about those nominal gains, the number on your screen. But the gold story, that's about your real purchasing power. It's about what you can actually go out and buy with your wealth. So, while your account balance went up, your ability to command real things in the world might have actually gone down.
All right, so let's dig into a metric that helps us see this relationship over the really long term. It's called the Dow-to-Gold ratio. And believe it or not, this thing has been mapping the huge turning points in the market with incredible accuracy for 2 centuries.
The idea behind it is actually super simple. It's not about the dollar price of stocks or the dollar price of gold. It's about their value relative to each other. When the ratio is high, stocks are expensive compared to gold. When it's low, gold's the expensive one. It's a way of pricing the market in something, real.
So picture this. It's 1999. We're at the absolute peak of the dot-com bubble. Stocks were flying high. At that point, it took 45 ounces of gold just to buy the Dow Jones Industrial Average. That was the tippy top for stocks in that cycle. Now, fast forward to today, the Dow has quadrupled in dollar terms, right? We've hit all these new highs, but look at the ratio. It's completely collapsed. Now, it only takes 9 ounces of gold to buy that same Dow. So what does that mean? It means that even with all those all-time highs, the Dow has lost about 80% of its real value when you measure it in gold.
So, let's put some real numbers to this. Imagine 2 investors back in 1999. They both start with the same amount of money, about $11,000. Investor A buys 45 ounces of gold. Investor B buys the Dow. What happens? Well, today, Investor A's gold is worth over $225,000. That's a 20x return. Investor B, who did the smart thing, their investment is now worth about $45,000, a 4x return. So in this race, gold created 5 times more wealth.
Now, you might be sitting there thinking, okay, this is some weird fringe idea. But looking at markets this way is actually based on a discipline that's over 100 years old. It's called technical analysis. And at its core, it's just the study of how markets have behaved in the past to help make decisions today. And get this, the whole field was basically started by Charles H. Dow. Yep, the guy who founded the Wall Street Journal and created the Dow Jones averages themselves. The main idea is that the price of something already reflects everything we know about it, the news, the data, even how investors are feeling. So by studying the price chart, you're studying the result of all that human action. And it all boils down to a few basic ideas. Analysts who use this believe that prices move in trends, and that these trends are driven by shifts in supply and demand that you can actually see on a chart. And the biggest assumption of all, that human psychology, the fear and greed that drives markets, is pretty consistent over time. You've probably heard the saying, history doesn't repeat itself, but it often rhymes.
That's why these long-term ratios can be so powerful.
So you might be wondering, why did this whole stocks versus gold comparison become so important in our lifetime? Well, the answer comes down to one single year that completely changed the rules of the money game.
See, before 1971, the US dollar was actually backed by gold. You could, in theory, exchange your dollars for a fixed amount of it. But in 71, that link was totally cut. The dollar became what's called a fiat currency, which is just a fancy way of saying it's backed by, well, faith in the government. And its supply could now be expanded whenever. That was the moment our financial ruler officially became elastic, and gold started its new life as an independent way to measure value.
Okay, so let's bring this all home and make it practical. You can actually apply the same kind of thinking to your own portfolio. You don't have to just take my word for it. You can run the numbers and calculate your own real purchasing power return.
It's a pretty simple four-step formula. First, figure out your portfolio's total gain in dollars. So if you turn 10 grand into 30 grand, that's a 3x gain. Simple enough. Second, you do the same thing for the price of gold over that exact same period. Let's say it went up 2x. Then, and this is the important part, you divide your portfolio's gain by gold's gain. So 3 divided by 2 is 1.5. And for the last step, you just subtract 1. Your result, 0.5, means your real return was 50%. It gives you a number that shows whether you actually grew your purchasing power.
Now, I want to be really clear here. This is not about saying stocks are bad and gold is good. Absolutely not. Over the long haul, stocks have been an incredible engine for creating wealth. The whole point of this is about perspective. It's about being aware of the ruler you're using and understanding that the story it tells you might not be the whole picture of your real wealth.
So, I'll just leave you with this question. Your brokerage statement is telling you one story, a comforting story of numbers going up. But market history, when you measure it with a different ruler, tells another story entirely, one about cycles, real value, and purchasing power. The question is, which one will you follow?